Yeah, so good afternoon, everybody, and welcome to the Nedbank interim results presentation for 2019. To those of you here who've joined us in the Boardman Auditorium, as well as those watching on the web and on the phone lines. I'd also just like to start by thanking the Investment Analyst Society for recognising Nedbank in the 34th IAS Awards, as Mike just referred to. It is indeed a great honour for us. And I think also last year we were voted at the Ernst & Young Excellence in Integrated Reporting Awards as the best integrated report as well. So as usual for the format of our presentation, I'm going to start with a high-level overview of the environment with some particular comments on structural reform or the lack of structural reform, as well as progress on our strategy and the H1 results. Rasibi will then take you through the detail of the numbers. Each of our cluster managing executives will talk to their respective cluster results, and then I'll come back at the end to look at our current expectations for the balance of the year. So many of you should have seen this slide in our presentations before. It's our relatively simplistic view of the key stages of the South African turnaround story that's been underway since early 2018. Unfortunately, while the turnaround has certainly started, progress has been disappointingly slow, as infighting has dominated the national discourse, and the reality is that we're still largely in the left-hand side of these boxes, the early stages of a political and institutional turnaround in South Africa. We've certainly seen some positive developments since the elections in May, the appointment of a new National Director of Public Prosecutions, a new SARS Commissioner, changes to ministerial positions, including a slightly smaller cabinet. However, progress on structural reform and policy certainty has remained far too slow. South Africa is fast running out of both time and money. And in our opinion, significantly more urgency is required on the implementation of structural reforms to prevent unsustainable fiscal deterioration. If we're unable to do this, all the hard work spent on maintaining our last investment grade rating from Moody's will have been in vain, at great cost to all South Africans, as a result of higher interest rates and higher inflation, and lower growth and lower levels of employment than otherwise would have been the case. If, however, we are more successful in accelerating structural reform, our delivery should shift from the foundational stages on the left-hand side, leading to improved levels of business and consumer confidence, increased levels of local and foreign investment, increased levels of inclusive economic growth, and as an outcome of that, reduced unemployment, poverty, and inequality. If we're able to do all of this, I do believe it is possible for us to step back from the current fiscal cliff and retain our investment grade rating from Moody's. It certainly is clear that our country is at a crucial economic juncture, one that will require coherent economic policy, difficult decisions to be made, and urgent actions by all South Africans. Against this context of delays in structural reform and policy certainty, confidence levels have remained low and economic growth has been continually revised downwards. If you look on the left-hand side here, you can see that we started this year with our forecast for economic growth in 2019 to be around 1.3%. In April this year, we revised this down to 0.9%, given in particular our estimate of the impact of the disastrous levels of load shedding that we saw in the second quarter of this year. Post the actual release of the Q1 numbers, we've again revised downwards our GDP forecast for the full year, now to only 0.5%, less than our population growth rate, which simplistically means that on average all South Africans are getting poorer. In the environment I've just described, it shouldn't be a surprise on the left-hand side here that both private sector and public sector fixed investment is declining. Actually, more so in the public sector, as the impacts of state capture become more evident as we hear in the various commissions of inquiry. On the right-hand side, we present what we think are key structural reforms and areas of policy certainty that we believe are urgently needed to drive confidence, investment and growth, together with our assessment of their impact on growth and likelihood of implementation. I'm just going to talk to the 5 items listed under urgent issues, and you can read the rest. Eskom Policy and Eskom in general remain the elephant in the room in the South African economy. Although in the short term, taxpayer funding has kept Eskom afloat, no one should expect any material investment decisions to be made with the current uncertainty as to the strategy, structure, leadership, operational capacity and long-term financing of Eskom, meaning it's simply not possible in any feasibility study to accurately forecast the price and availability of electricity. On land reform, while we all recognize that this is vital in the context of South Africa, the length of time we are having with ongoing debates around expropriation without compensation and no finality on either a land expropriation bill or amendments to Section 25 of the Constitution means that many investors will simply choose to sit on the sidelines and wait, or pursue other opportunities without these uncertainties. On the Saab nationalisation, we believe that this debate is an unnecessary distraction of our limited resources from the hard work of structural reform. And finally, on more recent debates on prescribed assets, in short, these are simply a very bad idea and will inevitably lead to investment outflows, lower growth and higher unemployment. I will leave you to read the short-term wins that I think we should be focusing on, as well as the issues that in our opinion are absolutely vital, but only likely to resolve or not, as the case may be, over the longer term. Looking now at our performance in the first half, I believe we have made good strategic and operational progress, and we delivered a resilient financial performance in a very difficult operating environment. On the strategic front, we've continued with our focus on technology investments and digital delivery as a means of enhancing client experiences, growing revenues and improving efficiencies. We are investing in building a bank that has the capability to lead in digital financial services. I'll provide a little bit more colour on this later, particularly on our delivery of our new digital retail onboarding platform that we call Eclipse, that happened in the first half. From a transactional franchise point of view, you will see as our managing executives present that we have grown main bank clients across the group. Reflecting on our financial performance at a high level, headline earnings was up 2.6%, headline earnings per share up slightly more than that at 3.5%, with solid revenue growth and good expense control, driving up pre-provisioning operating profit by 7%. However, this was offset by impairments that increased from the low levels we saw last year into the bottom half of our through-the-cycle target range. The interim dividend was declared at R7.20, up 3.6%. Rasibi is going to take you through a lot more detail on this later. Importantly, in the current difficult environment for corporate South Africa, Nedbank maintains high governance standards, and the bank is run with a strong focus on long-term sustainability, culture and ethics, while we deliver on our purpose of using our financial expertise to do good. In support of our ongoing role in the CEO initiative, in April this year, Nedbank became the largest corporate participant in the YES, or Youth Employment Service, and we created job opportunities for more than 3,300 youth inside and outside of Nedbank. And I strongly urge fellow corporates in South Africa to follow our lead in this nation-building initiative. We were also the first bank to launch a green bond on the JSE, and we achieved level 1 BBBE status under the new amended FSC codes. On the strategy front, again, investors will be familiar with this slide that I call the spine of our strategy. Our central focus at the top remains on creating great client experiences and, as a result, growing market share in key value-creating areas, with a particular focus on our transactional franchises, our shorter-dated lending franchises, and our deposit franchises. We aim to enable all of this through our investments in technology, called our Managed Evolution and Digital Fastlane programs, as well as changes that we're making to our people practices and brand. Given its strategic importance, I will again update you on the progress that we are making on our IT strategy in the next few slides. In the center of this slide, our target operating model, which is where it all comes together, is delivering the expected benefits. And now more than 1,500 of our staff are working under new ways of work. That's in agile squads and tribes. We are delivering innovations to market faster and cheaper than before, and our cumulative target operating model savings at the end of June were 826 million. And we remain on track for cumulative savings of 1 billion by the end of this year and cumulative savings of 1.2 billion by the end of next year. The benefits of these strategies, we believe, are becoming more evident in growing transactional client numbers and improving net promoter scores. These enablers should enable us to deliver on our 2020 financial targets of an ROE excluding goodwill greater than or equal to 18% and a cost-to-income ratio of less than or equal to 53%. And while the cost-to-income ratio remains our target, I do remind you that we did point out last year that the worse-than-expected macro environment, lower-than-expected interest rates, accounting changes, and new costs have made the cost-to-income ratio target in 2020 harder to achieve. Looking at progress on our Managed Evolution IT strategy that underpins our digital ambitions. Just a quick reminder here, in 2010 we embarked on mapping out a best-of-breed IT strategy and architecture that we call the Managed Evolution to digitize Nedbank's IT landscape and in so doing simplify, rationalize and consolidate our core IT systems that were then around 250 to 60 by 2020. We've made good progress on this journey that we expect to be materially complete by the end of 2020. And by June, we had rationalized 138 core systems, and we expect about another 20 will be rationalized in the second half of this year. This is the second time we've used this quite detailed slide to illustrate our progress on the Managed Evolution journey. And we're going to show you this slide on a consistent basis until Managed Evolution is materially complete. On the left-hand side, we show you our total spend to date since we started this program, 8.5 billion rand, which is up from the 7.7 billion in December. And this in total now represents a 65% completion rate, up from the 60% in December. We've made progress across all the key programs listed, but the key highlight in the period was the implementation of Eclipse digital onboarding for retail customers. And that's listed on the left-hand side under the block called Client Systems. There's some more detail coming on this on the next slide. And I'm really excited now about the products and services we intend to launch in the second half and into 2020 that will accelerate our digital journey and have a significant positive impact on client satisfaction levels, our own efficiency levels, and the competitive environment. So I said in June we rolled out Eclipse, our simplified end-to-end client onboarding system for retail customers. It's a material change in the way that we onboard clients and sell products, essentially moving from an old, slow, sequential paper-based process that had relatively low cross-sell rates to digitally onboarding a client once for life, fully automated across front, middle and back offices with much quicker onboarding and easier cross-sell, as well as digital KYC or FICA and a much lower cost to onboard. Across the organization, this was a massive IT and operational focus in the second quarter. We launched this capability to 4,500 of our bankers in our retail environment and into all 600 of our branches. And at the same time as we rolled out the onboarding platform, we launched the ability to digitally sell a current account and a transactional account off the back of the onboarding platform. In the second half of this year, we will land the next phase of Eclipse, and that is for juristic or wholesale clients, as well as rolling out individual onboarding onto the web and onto the app. And we're also going to expand those two products, personal loans and transactional accounts, to include cards, investments and overdrafts, with other products to follow in 2020 to achieve our goal of having our top 10 products available digitally off the Eclipse platform by the end of 2020. So this is quite a busy slide of our data reads over a very short time frame since rollout of Eclipse. And certainly the initial data reads are very pleasing. Client feedback and staff feedback has been excellent. If you look in the top left, what we are seeing is the benefits of significantly reduced account opening times, from previously around 45 to 50 minutes for a transactional product to now under 20 minutes for a single transactional or personal loan product, and around 35 minutes for a joint transactional and personal loan. The data on these slides represents the initial outcomes during June as we were rolling out. And as we mature these processes and our staff become more efficient, these times should improve further. And actually, right now, our faster users are able to onboard a transactional account in around 10 minutes. Following on from the June data usage on the bottom left of this slide, towards the end of July, we now have about 34% of all personal loan sales and 40% of all transactional sales being delivered through the Eclipse platform, up from the 14% and 37% at the end of June. On the right-hand side, we point out that Eclipse is not our only digital offering, and it builds on the enormous success we've already had in delivering great digital client experiences, including our top-rated digital apps and the improvement that we saw in our Net Promoter Scores last year. From a financial perspective, our focus on delivering value to shareholders is illustrated in this slide, our view of the key value drivers in a bank. On the left, our net asset value per share grew by a touch under 5%, as organic net asset value growth of 7% was offset by the day one IFRS 16 accounting changes, the impact of the odd lot offer that we concluded at the back end of last year, and FCTR losses in Zimbabwe, where we accounted for our subsidiary at a rate of 7.25 RTGSs to the dollar, compared to 3.88 in December last year. Our return on equity reduced off the high base of June last year at 18.4%, down to 17.9%. And actually at 17.9 is exactly in line with the ROE that we produced at the end of December last year. Earnings growth and the solid capital position enabled the declaration of an interim dividend of R7.20, up 3.6%. Finally, from me, a slide on the important role that Nedbank plays in delivering holistically to all of our stakeholders, evidencing our purpose statement of using our financial expertise to do good. There's lots of data on the slide that I'll leave for you to read. I'm just going to highlight a couple of key ones. Starting in the top left on the staff front, we continue to invest in our staff as we prepare our business for the fourth industrial revolution. Pleasingly, our staff surveys highlighted engagement scores are strong. Our workforce continues to transform to better reflect the demographics of our country, with nearly 80% of our workforce black. I'd also like to take this opportunity to point out that recent press reports on Nedbank retrenching 1,500 staff are simply wrong. We are integrating areas of our business banking and retail relationship banking environments. Whenever you integrate areas in a bank, you are required to consult with all staff members who are impacted by that integration. So we are consulting with 1,500 staff members who are impacted by that integration. We currently expect that about 1,400 of them will be placed in the new environment, and we have 100 people sitting in our redeployment pool, and ultimately we think that less than 50 may not be placed, but we continue to work to place as many as possible. On the client front, we remained firmly open for new business. Payouts were up 15% to 94 billion rand. We were disappointed that our share price underperformed the FINI in the first half of this year, following strong outperformance in the second half of last year. We interacted positively with shareholders and were pleased with our AGM voting outcomes and have ongoing engagements with our regulators. ESG matters remain top of mind for shareholders, and while we continue to play a leading role on environmental matters, we commit to further engage with shareholders on climate change. We're also celebrating a milestone in our history on the 20th of August this year, marking 50 years of Nedbank's listing on the Johannesburg Stock Exchange. We also remain focused on supporting and serving the communities in which we operate, as I outlined earlier in my presentation. I'll now hand you over to Rasibe to go through the detail of the financial results.
Thank you, Mike, and good afternoon, ladies and gentlemen. Firstly, just a big thank you to the Investment Analyst Society for the recognition for reporting and a recognition that we do not take for granted. Coming to the results, in the 6 months to June 2019, Nedbank produced a resilient financial performance. And looking at the income statement components, our headline earnings grew 2.6%, and our diluted headline earnings per share was slightly higher at 3.7%, benefiting from buying back and cancelling approximately 7 million shares post the odd lot offer that took place in December 2018. The decline in our economic profit was primarily as a result of higher cost of equity as bond yields increased. ROE excluding goodwill declined to 17.9%, as demonstrated by Mike earlier, and our ROE currently is in line with the end of the year 2018 at 17.9%. In the first half of 2018, it was increased partly as a result of the benefit of IFRS 9 day one impact. Pleasingly, our pre-provisioning operating profit increased 7%, and our cost-to-income ratio improved to 55.4%. As expected, our net interest margin decreased, while our credit loss ratio increased to within the bottom of our through-the-cycle target range, and I will unpack this a little later. The odd lot buyback resulted in a 34 basis points decline in our CET1 ratio, and this CET1 ratio supported our 3.6% increase in our interim dividend. This waterfall graph highlights the key drivers of our headline earnings. Revenue growth was solid, with NII and NRR both ahead of inflation and slightly ahead of cost growth, while impairments grew 40% off a low base. Strong growth in associate income was underpinned by the sustained ETI recovery. And again, I will unpack this a little later. Our NII increased 5.8%, supported by our average interest earning banking assets, which grew at 8.7%. And this was supported by solid growth in advances as well as high levels of high-quality liquid assets. Our net interest margin decreased by 10 basis points to 3.57%, and this decrease was primarily driven by negative endowment impact, negative asset pricing and mix impact, the implementation of IFRS 16 with effect from January 2019, and the low-yielding high-quality liquid assets for a combined reduction of 13 basis points. This decrease was partially offset by improved pricing on deposits, which added 3 basis points. Banking advances grew 6.5% year-on-year, driven by solid growth in our RBB and an increase in growth in our CIB's banking advances. As shown in the graph on the right, the acceleration in growth was underpinned by ongoing momentum in our RBB, having grown since the second half of 2015, and faster growth in CIB over the past year. Taking a product lens, term loans increased strongly year-on-year as the CIB pipeline converts and we benefit from renewable energy drawdowns. Commercial property grew at a more moderate level of 5%, losing market share as we focus on quality assets at appropriate pricing in a difficult property market. Retail advances growth momentum continued, as seen in strong growth in vehicle finance and personal loans, while growth in home loans is reflective of strong industry growth. Other loans, comprised of preference shares and other short-term loans, was down 10% due to reduced demand from our clients. Our deposits grew 8% ahead of advances, improving the group's loan-to-deposit ratio to 88%. Through active management, RBB, wealth, and CIB deposits grew between 8 and 11%. Rest of Africa deposits was negatively impacted by the depreciation of the Zimbabwean currency versus the rand. All our liquidity ratios remain well ahead of our minimum regulatory requirements. Returning to the income statement, our NIR grew 5%, reflecting strong underlying growth of the franchise. Growth was underpinned by our commission and fees that also grew 5%, driven by growth in main bank clients across all our businesses. Trading income grew 4%, notwithstanding weak markets, low levels of volatility, and generally a decrease in market volumes. Insurance income was flat on the prior year as good sales volume increases were offset by higher weather-related claims. Fair value was also a key driver given volatility in the group's hedged interest rate risk positions, as movements between the designated hedged exposures and the underlying hedges culminated in a net positive gain in the first half of 2019 compared to a loss in the previous period. Turning to credit loss ratio, the graph on the left provides an overview of the credit loss ratio increasing 17 basis points to 70 basis points, which is now within the lower end of our 60 to 100 basis points through the cycle target range. The key drivers were CIB and RBB increasing off a low base to within or just below the lower end of their respective through the cycle target ranges. Impairments increased 40%, driven by increases across stages 1, 2, and 3 impairments, as well as the low base, which included recoveries in the first half of 2018. Underlying changes include a decline in CIB Stage 3 impairments on the back of positive client resolutions and an increase in RBB Stage 3 impairments as defaults increased across the portfolio. Portfolio coverage declined marginally since December. Turning to Stage 3 advances, over the past 12 months, defaults increased by 18% to just below 27 billion rands, representing an NPL ratio of 3.6%. As can be seen on the left, the largest increase occurred between June 2018 and December 2018, primarily as a result of changes to our point of write-off methodology, which aligns to IFRS 9, as well as higher defaults in CIB at that time. The first 6 months of 2019, on the other hand, saw an improvement in CIB as we experienced greater levels of client defaults moving out of Stage 3 compared to new defaults. Stage 3 coverage increases to 37.1%. Expenses increased 5.5% as IT investments in the business were partially offset by ongoing efficiencies as well as once-off cost benefits. Our participation in the Youth Employment Service from the end of April was a new cost of 56 million rands. This nation-building initiative is expected to cost 1.5% of the South African business's net profit after tax. The final PRMA settlement of 354 million rands resulted in a net 104 million rands benefit in this half, while the IFRS 16 benefit was around 120 million rands. Unpacking expenses a bit further, strategic investments in skills in both CIB and IT was offset by benefits from reducing our headcount by more than 1,000 people year on year, largely through natural attrition. Annual salary increases across the group was 5.4%, while STI, or short-term incentive, declined 10%, in line with weaker business performance. As noted before, our ongoing investment in technology and digital investments saw computer costs increase 14%. At the same time, these digital investments continue to drive efficiencies and support our digital strategy as demonstrated in Mike's slides a little earlier on. In the first 6 months, we unlocked efficiencies of just under 190 million rands. As reflected in my earlier slides, associate income continues to reflect an ongoing recovery at ETI, and Fundo will give you a broader perspective on this. Just covering on the carrying value, our carrying value declined further by approximately 300 million as stronger levels of associate income was offset by FCTR and OCI changes. ETI's large FCTR changes occurred after they transitioned from the Central Bank of Nigeria's rate to the NAFEX, as well as changes in their reserves. Given the carrying value of our investment in ETI being above the market value, we continue to monitor the valuation of this investment at each reporting period for inter alia indicators of impairment. At this stage, our value in use calculation exceeds our carrying value and therefore supports the book value of our investment. The group remains well capitalized at levels significantly above the minimum regulatory requirements. The CET1 ratio of 11.3% was impacted by the implementation of IFRS 16 on the 1st of January 2019, the ongoing investment in software development as part of the group's managed evolution program, the adverse impact of changes in currency translation reserves, and adverse migration in certain credit portfolios. Our dividend was paid around the midpoint of our target range, and we foresee continue to pay dividends within our target range. A brief overview of our performance in the clusters show that our headline earnings growth in our two larger clusters, CIB and RBB, was flat, while Wealth had a subdued 6 months. Rest of Africa continued to grow strongly given the recovery of ETI, although the performance in our subsidiaries was impacted by one-offs and the adverse impact of Zimbabwe's monetary policy changes. The ROEs of our South African businesses were impacted by muted earnings growth, while allocated capital increased in line with loan growth. Before I hand over to Brian Kennedy, I would like to unpack the movements in the center. Our earnings from operations were slightly down, with the growth boosted by the center, including some non-repeat items as follows. During the period, we released 50 million rands pre-tax of our central overlay as risks emerged in the underlying businesses. As I mentioned before, fair value changes resulted in a sizable year-on-year swing. As we noted during our 2018 year-end presentation earlier this year, we stated that in the first half of 2018, the center benefited from 250 million rands PRMA release, and in the first half this year, we released a further 354 million rands, being the final benefit of the scheme that is now in a run-off stage. I now want to hand over to Brian to take you through CIB's performance.
Thank you, Rasibi, and good afternoon, everybody. CIB's results reflect a solid performance, with gross operating income increasing 6.7% to 7.9 billion. Headline earnings were flat due to increased impairments, costs associated with continued investment in key product segments, and margin pressure from increased competition for quality assets. This resulted in ROE declining to 19.2%, as economic capital increased 4.7% to 34.7 billion due to asset growth as well as rating migration across stressed sectors. NIR has shown good growth in the first half of 2019, increasing 7.7% to 4.154 billion, with continued growth in fee and commission income as a result of deal flow and good trading revenue performance, indicative of the franchise strength. NIR grew 5.5% due to advances growth in our term lending portfolio, following conversion of a good pipeline in the first half of the year. As indicated previously, the credit loss ratio increased to 16 basis points, but is, however, still within our through-the-cycle target range of 15 to 45 basis points. Our cost-to-income ratio remained flat at 40.9% as we position key focus areas by investing in talent whilst capitalising on digital opportunities to ensure an improved client experience. Growing NRR has been a strategic focus area since the formation of CIB in 2015, and it's pleasing to note this upward trajectory continuing in 2019, with continued growth across all our business units after achieving a 19% growth in 2018. Fee and commission income grew strongly at 7.8% as a result of deal activity in our term lending business. We continue to focus on growing our primary bank clients, and our ongoing success has contributed to the growth in transactional NIR for the year, which forms part of the fee and commissions line. The 16 new primary bank wins to date will contribute to increased transactional revenues. Low volatility and decreased volumes impacted our markets business. Despite this, we still grew trading income by 4.7% off a high base of the first half of 2018. Markets continues to develop market-leading trading capabilities across the asset classes, expanding our reach now into cash equities in the first half of 2019. With continued investment and focus on growing talent across these businesses, it's pleasing to see the NIR to expenses ratio maintained year on year at 127.9%. The NIR to advances ratio has also improved significantly from 1.95% in 2015 to 2.27% in 2019. Over the last 4 years, we have built and maintained our leading position across most major league tables, and this is illustrated in the booklet slide. Looking at advances, CIB has continued to be a significant debt provider to corporate South Africa, with growth of 9% in actual banking advances, including corporate bonds, as we closed significant deals in the first half of 2019. Investment banking had strong growth due to pipeline conversion during this year, as well as increased drawdowns on deals written in the latter part of 2018, including the renewable deals, as Rasibi mentioned. Growth has been more muted in property finance, as we have been more selective in our origination, although we have maintained our lead in market share. The pipeline of new business remains strong, and continued growth in advances is expected for the remainder of the year. It was also pleasing to note that CIB was recognized in the Banco Awards with the Infrastructure and Project Finance Deal of the Year, as well as Sponsor of the Year in Project Finance International. The pleasing feature in this set of results is the credit loss ratio of 16 basis points, which is still at the lower end of the target range. It continues to highlight the quality of new business, proactive risk management, as well as our capable involvement with clients to restructure and resolve distressed assets. The portfolio coverage ratio on the performing book increased to 37 basis points due to the migration of risk ratings, mainly in the high-risk industries. The agri and telco sectors are the main contributors here. Defaults have increased from 5.1 billion as of June 2018 to 5.4 billion as of June 2019, due largely to the construction and cement industry, as well as a few specific overgeared corporates. However, early engagements and restructures allowed a large portion of the defaulted book to be restructured to reduce significant risk, which has resulted in lower defaults since December. In addition, due to the relatively higher longer-term lending portfolio of CIB, a high percentage of our book is collateralized. The high level of collateralization of these defaulted deals has resulted in a lower specific coverage ratio of 12.8%, noting that this is up from 11.6% in December of 2018. In 2019, we will continue to closely monitor the stressed sectors of the economy, such as construction and cement, clients including REITs with large office and government exposures, and parts of the retail sector. Focus will also continue on certain SOEs as a result of the rising government debt burden and ongoing uncertainty in terms of the SOE's liquidity, although progress has been noted in the board and management changes of some of these counters. Net interest margin decreased to 2.1% from 2.13% in June 2018, with asset margins coming under pressure as we continue to target high-quality assets. More information is included in the booklet slide. So turning to prospects for CIB, Our focus for the rest of 2019 remains on serving our clients by delivering client solutions and insights through a sector-led approach and to enhance our revenue synergies across the business. Growth in earnings is clearly dependent on an improvement in business and consumer confidence. Building on our past success, we will continue to expand NOR growth, not only through transactional banking and trading, but also expanding our advisory and private equity business. We have also made key hires in the last 6 months in our equities franchise, which will position us for growth in these areas. Essential to our strategy is utilizing our strategic partners to benefit clients in South Africa and the continent. We continue to capitalize on our leading property positioning and have started to win a number of major transactions on the continent. Our 2020 targets remain a ROE of greater than 20% and a cost-income ratio of less than 40%. Thank you very much for your attention. I'll now hand over to Sicko Thomas to deal with RBB.
Thank you, Brian, and good afternoon, everyone. Retail and business banking headline earnings increased marginally by 0.3% in this period, with quality underlying earnings growth adversely impacted by a higher impairment charge from the previous year's low base. Pre-provisioning operating profit is up by 9.9%, driven by an NII growth number of 6%, underpinned by good growth in both advances and deposits. Solid NIR growth of 6.9% from growth in both volumes as well as average pricing increases. RBB expenses grew at a judicious 3.6% in the period. This is after including our investment in physical and digital distribution. This modest growth was achieved through an ongoing focus on active management of costs and the impact of optimizing process in our operations. The credit loss ratio has increased to 128 basis points. At 128 basis points, it is just below our target range of 130 to 180 basis points. Allocated capital increased in line with good growth in advances across the lending book. This, coupled with flat earnings as reported, has translated into a lower ROE of 17.3%, down from 18.6% a year ago. Impairments in RBB are up by 30% of last year's low base, mainly due to an increase in the Stage 3 defaulted book charge, given a macroeconomic environment that remains challenging for consumers as well as businesses. The higher impairment charge has been offset by an increase in the realization of interest on impaired financial advances, as well as a reduction in impairments on Stage 1 and 2 loans. The credit loss ratio of 128 bps is, however, still below our target range of 130 to 180. Traditionally, we experience a reduction in the impairment charge in the second half of the year. However, the risk on impairments in H2 is likely to remain elevated and is likely to be on the upside, given the continued tough economic environment in which we're operating. NIR in retail and business banking grew by a solid 7% in this period. Main banked client numbers grew by 4.9%, reflecting good progress in quality client acquisition and improved retention. Pleasingly, this chart shows that retail banking NIR, as well as transactional NIR, grew at 7% too, both ahead of main banked client growth, evidence of the deeper client penetration we continue to drive and target in retail and business banking. This growth in NIR is despite the moderate increases we took in average pricing. It continues to benefit from the growth in overall main banked clients. In this period, it is worth noting that the overall client number has reduced to 7.4 million due to accelerated closure of dormant accounts. Dormancies were notably higher in this period due to market inactivity in a market environment of markedly lower transactional activity by our clients. We continue to focus strongly on the client-centered growth strategy in retail and business banking. In this now familiar slide, we unpacked our main banked client growth by client segment. Growth has been strong in almost all of our client segments. Both the small business segment and professional segments have grown above 8%, and the entry-level banking segment grew at 7% in this period. All of the other client segments have shown good growth too in the year thus far. The exception is, of course, the youth segment. We, however, are confident that our growth plans for the youth segment, underpinned by the compelling zero monthly fee unlocked.me proposition, which was launched in January, will help arrest this decline. We have made significant progress in the past year, accelerating our digital transformation journey with core capabilities built to give us a sustainable competitive advantage for our products. The client convenience capability of Eclipse for individuals was a major highlight for RBB in this period, and Mike dealt with it in detail in his section earlier. In this slide, we highlight another 4 products that we've launched in this period. Left to right, I want to highlight firstly the Nedbank pay-as-you-use zero monthly fee account, which is enabled by the digital onboarding and staff-assisted power of Eclipse in branch. Secondly is Nedbank Mobi Money, which is a zero monthly fee USSD mobile account, which we launched at the back end of 2018 to help us accelerate inclusive banking. Third is MFC P2P, which is a digital capability that offers safe and hassle-free vehicle financing between a private seller of a vehicle to a private buyer of the same vehicle. Finally is my personal favorite, Hey Ned. It gives clients access to a full 24/7 private concierge service across more than 350,000 service providers across South Africa, all from the convenience of the Nedbank Money app with inbuilt secure payment capability. Through the launch of the above-mentioned zero-fee accounts, we are strongly driving financial inclusion and directly addressing the cost of banking services. It's worth mentioning that all 3 were the first zero monthly fee transactional accounts launched in South Africa by a major bank. We continue to accelerate the efforts of digitizing our operational environment. This slide shows that digitally enabled clients grew by 4% to just over 6 million. In this period, digitally active clients increased by 17% as we continued to lend more services across both web and the Nedbank Money app. We've also seen a big uptick in Money app downloads as a result, and as a result, we saw a 119% increase in the number of active users now using our highly rated Money app. Third-party payments coming through the Money app are up 71% from a year ago. The migration of cash from branch to self-service devices continues to grow. The volumes of cash deposited onto our self-service devices is up by 22% in this period. Digital value-added service products are also pleasingly up by 26% as we continue to leverage digital channels to make it easier and more convenient for our clients to effect their transacting needs. This slide reflects how our investment in digitization continues to further assist our operational optimization efforts. Headcount has been managed actively, with a resulting reduction of 1,300 heads and an actual reduction in branch space of over 37,000 square meters, a full 16% reduction in the total branch floor space we occupied from 5 years ago in 2014. The total number of retail outlets has also reduced to 592, down from 608 a year ago. Robotic process automation is accelerating in our operational environment, enabling us to automate manual processes and improve our speed and accuracy. We have now deployed 83 fully automated robotic processes cumulatively since 2018. All of these optimization efforts have resulted in efficiencies of 176 million to be realized in this period. Good growth in most of our lending businesses continues to drive gains in market share. Gross advances in RBB have increased by almost 8%, solid in a challenging macro and in an environment of strong competitor activity. This increase of 8% is driven by strong growth in business banking, relationship banking, personal loans and vehicle finance. There has also been a significant increase in payouts across the business, with RRB and business banking growing payouts by 13% and 20% respectively. Finally, both home loans and MFC continue to enjoy good gains in market share as reported in the BA 900s. Business banking continues to be well positioned for growth despite the challenge of accelerated impairments in this period as the credit loss ratio normalizes from low recent levels. As a result of higher impairments mostly, headline earnings reduced by 8% in this period. Growth in impairments have resulted in the credit loss ratio rising to 38 basis points, up from a low of 10 basis points a year ago. The rise in the impairment charge is driven largely by client flows into default from the very low base of 2018. Pre-provisioning profit, however, is up 2% year-on-year, supported by asset growth of 11%, LIBOR growth of 9%, and NIR growth of 6%, a demonstration of a performing underlying business. These results have been delivered despite the slow economic growth, which has seen lower levels of business confidence, with business owners delaying key investment decisions as they manage their cash flows more carefully through the cycles. The lower earnings driven by the normalization of impairments and a 60 basis point increase in the cap rate have combined to give rise to a reduction in the ROE to 18.8% from 24.2% a year ago. Business banking, however, remains a robust business, well positioned to support the growth of the economy of our country and its people. And finally, on to prospects for the rest of 2019. We remain committed to our client-centered growth strategy and boldly executing on our plans to deliver delightful client experiences through digital transformation using the now familiar 5 strategic levers reflected on this slide. We continue to drive towards achieving our targets for 2020, which include an ROE of greater than 20% and a substantially lower cost-to-income ratio, which is going to be more difficult to achieve, we acknowledge, in the short term. We are driven to build sustainable and profitable businesses through the cycle that add value to the lives of our clients. Our focus remains on accelerating financial inclusivity through our banking proposition to meet evolving client needs, through delivering competitively priced products, actively reducing transaction costs for our clients through digital banking services, and tapping into ecosystem-based platform proposition that offers solutions beyond banking. Thank you very much, and I'd like to hand over to Islander.
Thank you, Tiko, and good afternoon. Nedbank Wealth's headline earnings declined 12.3% to 455 million rand with ROE of 22.3%. Allocated capital remained flat at 4.1 billion rand, however lower earnings impacted negatively on ROE. Wealth Management International delivered a strong performance with pleasing year-on-year headline earnings growth. Subdued investor sentiment impacted the domestic wealth and asset management business, resulting in a decline in headline earnings. Significant weather-related claims adversely impacted the performance of the insurance business. Taking a look at our divisional performance, overall Wealth Management's headline earnings declined 17.9% to 96 million rand on the back of weaker performance in the local business, bolstered by stronger performance internationally. Advances remained relatively flat, while deposits increased by 8.4%. Internationally, Wealth Management delivered a notable uplift in year-on-year earnings, underpinned by an increase in the number of high-net-worth clients and strong deposits growth. Nedbank Private Wealth was named Best UK Private Bank at the 2019 City of London Wealth Management Awards. Subdued investor confidence affected the local business, resulting in reduced market activity, which impacted brokerage fees. Portfolio management fees declined due to weaker investment returns and a shift in product mix with investors de-risking their portfolios to lower margin products. We've seen an increased collaboration between our local and international private wealth businesses, which has supported the increase in the number of South African clients in the international book to 32%. Moving on to insurance, asset management. Subdued investor confidence across the asset management industry drove investors towards lower risk and lower margin products. Despite this, Nedgroup Investments net flows increased to 12 billion rand, driven by low risk income and cash solutions, with overall AUM increasing 2.9% to 323 billion rand. Headline earnings decreased 13.3% to 144 million rand, mainly as a result of the change in AUM mix. Nedgroup Investments remains a solid franchise, ranked 5th unit trust manager and 3rd largest offshore unit trust manager. Moving on to insurance. Insurance headline earnings decreased 8.9% to 215 million rand due to the cyclical nature of claims in the short-term business, which was favourable in 2018 and unfavourable in the current period. This was offset by an increase in sales and lower claims in the credit life portfolio. Normalising for the unfavourable claims experience, insurance earnings would have increased by 11.5%. Life value of new business increased 33.5% to 231 million rand, and life embedded value, which is reflected in the booklet side, increased 24.7% to 3.3 billion rand, mainly due to the change in the statutory commission in the credit life portfolio. Non-life gross written premiums grew 1.5% to 625 million rand due to an increase in the vehicle value-added product premiums, offset by lower volumes in the homeowners cover. You will recall in March that I mentioned Nedbank Insurance, as part of Managed Evolution, successfully completed the implementation of the single policy administration system for life and non-life products. I'm pleased to let you know that this was recognised as Salent's 2019 Model Insurer of the Year in the Legacy and Ecosystem Transformation category. Taking a look at recent developments to enhance client experience, we continue our focus on leveraging innovation and digital enhancements to improve client experience. In wealth management, we launched the stockbroking website, which offers clients enhanced security, research-based trading ideas, JSE-listed instruments, and selected derivatives. We continue to enhance the Nedbank Private Wealth app with new features and functionality. In asset management, we introduced Extraordinary Life, an automated online investment portal. The business also launched digital onboarding and has automated 50% of transactions. Progress has also been made to integrate into other Nedbank digital assets. Nedbank Insurance developed Sensible, a telematics device that connects a geyser through an easy-to-use app, enabling clients to adjust temperature, track electricity usage, and reduce latent damage. Finally, turning to prospects. We anticipate continued economic headwinds which will negatively impact our clients and businesses. Market conditions are expected to remain less than robust, with subdued investor confidence impacting appetite for trading and business volumes. Internationally, the UK continues to be impacted by the uncertainty relating to the outcome of Brexit on the property market, as well as increased competition from ring-fence banks. We will continue to focus on improving client experience through digital innovation and enhanced value propositions. A top priority will remain long-term investment performance and driving market share growth across all of our offerings. We remain committed to achieving our 2020 ROE target of 30%, mainly through cost containment, growing our international business and improving penetration into Nedbank. As indicated to the market in March, our 2020 cost-to-income target has become more challenging to achieve given persistent subdued investor confidence. It now gives me pleasure to hand over to Mfundo.
Thank you, Yolanda. In an environment of economic headwinds and currency volatility, The Africa business grew headline earnings by 19.6% to 293 million rand, improving the return on equity to 9.8%. The growth benefited from ongoing recovery of the investment in EcoBank, Transnational Incorporated, otherwise ETI. ETI contributed headline earnings of 264 million rand, a growth of 97%, driven by strong performance from the core West African regions, anchored by Ghana and Cote d'Ivoire, respectively, a strong recovery in Central, Eastern, and Southern Africa, and negated by poor performance in Nigeria, as that business continued to encounter headwinds. The subsidiaries in SADC had a mixed performance, weighed down by macroeconomic pressures and monetary policy changes in Zimbabwe. Headline earnings fell by 74% to 29 million rand. Excluding the volatile earnings in Zimbabwe and some once-off charges, the earnings would have been up 21% to 87 million rand. I will discuss these effects in the next slide. Pre-provisioning operating profit was down 23.5% as the net interest margin compressed and NIR declined due to lower economic activity and a 2% tax on digital transactions in Zimbabwe. Impairments were flat, and expense growth of 1.1% was well below inflation. As indicated in the foregoing slide, headline earnings for SADC subsidiaries decreased by 74% from 111 million rand in the first half of 2018 to a soft 29 million rand in first half of this year. The performance was adversely affected by Zimbabwe, which swung from earnings of 38 million rand in the first half of last year to a loss of 3 million rand this time around, and some once-off charges. Excluding Zimbabwe and the non-operational and deferred tax write-offs of 27 million rand and 34 million rand respectively, the earnings would have grown by 21% to 87 million rand as shown on this graph. Following the introduction by the Reserve Bank of Zimbabwe of RTGS, real-time gross settlements dollars, as a means of exchange in October of 2018, we used the FX rate of 3.88 RTGS dollars to US dollar in our closing balances in 2018. The currency continued to slide during the course of the reporting period, and we closed with the FX rate of 7.25 RTGS dollars to the US dollar as at end of June 2019. Consequently, our share of the NAV of Nedbank Zimbabwe was 64 million rand as at 30 June, representing less than 0.1% of the group's net asset value. We remain cautious of the impact of monetary policy influences on the exchange rate for the second half of the year. On financial drivers of the underlying business, notwithstanding the decline in headline earnings, the SADC business showed resilience in a challenging economic environment. Average advances and average deposits grew by 6% and 11% respectively, due to the depreciation of the Zimbabwe dollar against the rand. Excluding Zimbabwe, average advances were up 10.2% and average deposits increased by 18.4% respectively. NII grew by 3%, while the net interest margin fell by 30 basis points, reflecting the pricing squeeze on new asset creation. NIR declined by 12% on account of lower activity levels and the impact of the 2% tax on digital transactions, as mentioned before. The cost-to-income ratio deteriorated by 4%, reflecting the pressures on revenues and good management of costs. Turning to non-financial performance metrics, client numbers grew by 7% as we focus on the delivery of improved value propositions and the workplace banking initiatives. Digital transaction volumes fell by 3%, negatively impacted by the tax introduced in Zimbabwe on digital transactions, but increased by 66% off a low base in the other countries. The number of point-of-sale devices grew by 29%, resulting in 7.3 billion rand in merchant turnover for the first half of the year. Headcount growth was contained at 2%. Infrastructure investment was limited to high-growth segments in which we are underrepresented, with 2 additional branches and 4 ATMs installed during this period. We continued to invest in our client value propositions and to deliver solutions that respond to client needs. We implemented the award-winning Nedbank Money app in Lesotho, Namibia, Swaziland, and Eswatini. The new Money app has 19 additional features for the convenience of clients. The drive is now to convert clients to transact with us on the cheaper and more convenient digital channels as we upgrade features and deliver new functionality in more rapid development cycles. In Namibia and Eswatini, we launched an improved corporate internet bank solution. In Mozambique, we further improved mobile banking and online offerings in Banco Unico. Leveraging the relationship with SAA, we launched the Unico Voyager credit card to enable clients to earn Voyager miles as they transact with the Unico credit card. In Zimbabwe, we launched the Nedbank Youth account, offering 0 monthly service fees. We will keep the focus on improving the client experience as we implement the Nedbank Mobi Money solution for clients and upgrade our personal internet banking to align it with the mobile app in the coming months. Turning to ETI. ETI has delivered 10 consecutive quarters of profitability as the recovery momentum continued. The ETI earnings contribution of 264 million rand for the period Q4 of 2018 and Q1 of 2019 benefited from recoveries and lower impairments. The core West African businesses performed strongly, achieving an aggregate increase in profit after tax of 52% and a combined ROE of greater than 30%. The Central, Eastern and Southern Africa region recorded a strong recovery, with profit after tax up 92% and an ROE of 37%. The economic environment in Nigeria remains challenging, and EcoBank Nigeria continued to underperform, with a decline in profit after tax of 99% and an ROE of 2%. The performance was primarily affected by the decrease in interest-earning asset balances, subdued client activity, and the suspension of interest income accruals on mainly subsidy-related oil and gas exposures. The transition from the official rate of the Central Bank of Nigeria of 306 naira to the US dollar to the NAFEX rate of 364 naira to the US dollar in November of 2018, and FX translation changes also adversely impacted the result. The return on the original cost of the ETI investment of 6.3 billion rand improved to 12.3% compared to 7.9% in H1 of last year. Looking ahead on prospects for the rest of Africa, Nedbank remains committed to long-term and profitable growth in our Africa business. Our ambition is to provide our clients with access to the best financial services network on the continent. We expect the ROA business to continue to contribute positively to earnings growth for the group for the full year. In our SADC business, we expect an improved performance in H2 of the low base in H1 as once-off charges do not recur. We, however, remain cautious on Zimbabwe as the economic headwinds and currency volatility are likely to persist. The ongoing review of business portfolio will continue as we seek to optimize capital allocation and returns. We will improve the controls environment as we respond to the regulatory change program on risk and compliance, anti-money laundering, and market conduct. ETI has guided the market to a flat year-on-year forecast. As we report ETI results a quarter in arrears, we expect their contribution to be growth positive in our full-year financials, as our share of their profitable Q2 result will be reflected in our Q3. Our commitment to 2020 targets remain unchanged, namely to provide an ROE greater than cost of equity and a cost-to-income ratio less than 60%. These targets will, however, be challenging to achieve in a tough macroeconomic environment, as they are highly dependent on stronger revenue growth and capital optimization. I thank you and hand back to Mike.
Great, thanks, Mfundu. So now, having spent most of the presentation looking backwards, I'm quickly going to close with 2 slides that are more forward-looking. So this represents our latest forecast for key macroeconomic data in South Africa. And for all of the reasons I outlined earlier, we now expect GDP growth this year to be weak at 0.5%, with stronger growth in sub-Saharan Africa at just over 4%. Our forecast for inflation is that it will remain well within the SARB target ranges for 2019, with some increases expected in 2020 and into 2021. And as a result, our forecast for interest rates after the 25 basis point cut we saw in July are that we currently expect that interest rates will remain stable for the balance of the year and, in fact, into 2020 and 2021. But there is obviously a possibility of a 25 basis point cut in September. On credit growth, we expect this will continue to improve off a low base. Finally, then, turning to our usual format of guidance for the full year ahead, based on the macroeconomic forecasts you've just seen, based on our financial performance in the first half, as well as the operational and strategic progress we have made. Changes to the guidance that we gave at the beginning of the year are shown in brackets for your convenience. Starting with net interest income, which is made up of 2 parts. Average interest earning banking assets we expect to grow at mid to upper single digits. That's no change on our previous guidance. And on the net interest margin, we expect that that will reduce from the 2018 level of 365. Again, no change on our previous guidance and in line with the trajectory that you've seen to June. Turning to the credit loss ratios, we expect that the credit loss ratio for the full year will remain in the bottom half of the through-the-cycle target range, with a slightly better performance expected in the second half of the year, although in the current macro there is some risk to this forecast. Also, again, no change to the overall forecast. On non-interest revenue, given the weaker macro environment and weaker markets that we've seen, we forecast for NIR growth to be slightly downwards from slightly below our previous forecast, now around mid-single digit growth. Previously we had mid to upper single digit growth. Finally, on expenses, in response to the slightly weaker revenue growth, we have also revised downwards our forecast for expense growth, mostly in variable pay and costs, with no impact on our strategic investments, particularly in technology. So if we take all of this together then, we now forecast diluted headline earnings per share growth in 2019 to be slightly lower than our previous forecast, now around nominal GDP growth, and previously we were at greater than or equal to nominal GDP growth. And from our previous forecasts, you can see that nominal GDP growth is expected to be somewhere around about 4.9%, 0.5% GDP growth and 4.4% inflation. So that concludes the presentation on the interim results.